we have to be very careful about associating the economy with the stock market. They're two very different things. And it's funny, I was in Vancouver in January, and I'm a precious metals guy, I'm a macro guy. I look at debt levels and currencies, and I look at bond markets and Fed policies and dishonesty and disingenuity, which is fact proven. And they said, but Matt, what's your view on the markets? I'm actually very bullish on the markets when the Fed is acting dovish or talking dovish and then eventually becoming dovish. It's a massive tailwind for stocks. That was in January, and since then, of course, the markets have reached all-time highs. So has Bitcoin and gold and other assets. But it wasn't a surprise to me when Powell was talking dovish at the end of 2023, and then when even the last meeting last week, when he's basically said he's going to be forward guiding rate cuts sometime in 2024. That's a massive tailwind for risk assets. And it's also a massive indication they're going to devalue the dollar, which is another conversation. So and if you even look at volatility on the MOVE index on the Treasury, the markets are anticipating that Powell will actually stick to his word and cut rates sometime this year. So the markets are ripping, and they're ripping on actual net income margins on 5 or 6 names in the S&P 500, which I've said is the S&P 5, really. But it's not a surprise, but it's very important that we distinguish the ripping Fed-generated, Fed-dependent Pavlovian S&P and NASDAQ. Again, the NASDAQ is 50% of it is based on 10 names, and the S&P 500, as I've said, quantifiably equally weighted, is led by 5 companies. The other 495 are actually net negative since 2021. So yeah, the index of the S&P is ripping, the NASDAQ is ripping, NVIDIA is ripping. But again, that doesn't mean Main Street economy is ripping. It's a debt-based economy. We've got 6% GDP growth based on 23 trillion in issuings of bonds and notes and T-bills, which have massive implications. And to me, debt-based GDP growth is not growth, it's just debt. And that's not an exaggeration, it's just simple math. And then if you look at the actual Wall Street indicators, as I've said many times in the year since we've spoken, if you look at the M2 money supply, which, Hanke at Johns Hopkins made a good point, that's always deflationary and recessionary indicator. When you look at the Conference Board of Leading Indicators, we went into a recessionary threshold at the December of last year, 2022 into 2023. When you look at the layoffs, when you look at the real data at the BLS, not the reported data, and again, it's not sensational. Nick Eberstadt's done a finer job than me of looking at what real full employment really looks like, because it's not full employment. So the narrative that full employment is strong and the GDP is strong, I think is just farcical. And again, it's not trying to be sensational. And then if you look at, again, the layoffs, the record-breaking bankruptcies, I'd say it's anything but a soft landing, and it's simply going to get harder